Chapter 18, Part 1, Corporations. What we've all been waiting for, right? The biggie, the big type of business. Okay, a corporation is defined as a legal entity created and recognized by state law. Corporations have one or more shareholders that are comprised of either natural persons or other businesses, like other corporations, LLCs, partnerships, etc. Corporations, by the way, are not necessarily the largest number of businesses, but certainly account for the greatest amount of capital overall. For purposes of law, we treat corporations mostly like a legal person enjoying the same or similar rights to a natural person and the same privileges, with some exceptions. So corporations can sue and be sued. They have certain constitutional guarantees like free speech, due process, freedom of unreasonable searches and seizures to some extent. Shareholders can sue the corporation and be sued by the corporation and bring what's called a derivative suit. A derivative suit is a situation where the corporation has a legitimate claim against a third party, and for some reason the corporation is refusing to bring that claim against that third party. In that situation, a shareholder can bring what's called a derivative suit against the third party. If successful, the third person doesn't benefit personally other than as a shareholder. The corporation gets the benefits of that lawsuit, that derivative lawsuit. Okay, so a corporation has to be formed under state or federal law. There are some federal corporations that have been created by Congress, such as the Tennessee Valley Authority, the Legal Services Corporation. Those are special corporations. It's considered to be sort of an artificial person because it has some of the rights of people but not all of them, and is obviously not a person. So for example, when a corporation commits a crime, you can't put a corporation in jail. However, they can be fined. It's kind of invisible, intangible, and really exists only in contemplation of law. It does have a personality that's distinct from the shareholders or the owners, but it has to act through its agents. It can persist or exist perpetually, or it can have a finite time in which it exists, depending upon how it was created through the state laws. As I said, it accounts for about 85% of gross business receipts, the largest amount of capital. I think we covered most of this. The shareholders are generally screened from personal liability. They only risk the amount that they spend to buy shares of stock, their investment. So here are the advantages and disadvantages of a corporation. First advantage, limited liability of shareholders. We already talked about that. Business continuity. Really a lot of business continuity. Probably not a good way of saying it, but at any rate, for example, Coca-Cola probably has millions of shares outstanding. If somebody owns 1,000 shares of Coca-Cola and they die, nothing happens to Coca-Cola. If they transfer their stock to some other person, nothing happens to Coca-Cola. It's happening all the time. Ability to raise capital. So, how do corporations raise capital? Okay, they raise capital by selling more shares of stock, by borrowing money from lending institutions, or by issuing bonds called debentures, in which people buy bonds of the corporation that are paid off by the corporation over time with interest. They have centralized management and easily transferability of ownership. The disadvantages, of course, there's a lot more formalities to being a corporation, including the articles of incorporation and the bylaws. Double taxation. The corporation itself pays an income tax when the corporation passes the money on to its shareholders in the form of dividends. Those dividends go on your 1040 form, the front page on the line where it has interest and dividends, and you pay tax on that. And actually, I argue that corporations in a way are triple taxed. And how's that? Okay, there's a thing that's called capital gains tax, if you've never heard of it before. It's a tax that you pay when you have an appreciation in certain types of capital. One type of capital that you could have a gain in is stock. So if you buy a share of stock for $10 and you sell it for $20, your capital gain is $10. You pay a tax on that, depending upon whether you sold it within a short period of time or a long period of time. Tells how much tax you pay on it. There's a long-term capital gain, and then there's a short-term capital gain. So that's another tax that affects corporations. Okay. Corporations also have an advantage in that they qualify to offer certain benefit employee plans, which provide a tax deduction to the corporation. That's why you see large employers today have these cafeteria plans where they offer insurance, not just health insurance, but life insurance, long-term care insurance. They can offer daycare. They can offer legal services. They offer all different types of things that can provide the employees with a benefit, and sometimes if the employer is paying part of it, it benefits them with a tax deduction. The corporation or the shareholders can choose their tax year. They don't have to go January to December. They can go some other period of time if it suits the nature of their business. Has perpetual existence. You may be subject to state taxes. Some states have a corporate income tax. Some do not. And of course there's legal expenses. As we said, shareholders are shielded from liability except when the corporate veil is pierced, and that's similar to what we talked about with LLCs. Okay, so when a corporation owns profits, they can either give those profits back to the shareholders in forms of dividends. You may have heard earlier this year, I think it was in January, Delta Airlines had this huge profit and gave these huge earnings to their employees and their shareholders. And those are as dividends. Okay. They can also take their earnings and reinvest it or hold it in cash in their accounts for future use. Okay, we talked about taxation. Criminal and tort liability. Under respondent superior, corporations have liability for the actions of their employees under the scope of employment. They can also be guilty of criminal acts performed by their officers. They cannot go to jail, of course, the officers could, but the corporation itself can't. but it can be fined or it could be dissolved by the court if the actions are severe enough and meet the requirements for dissolution. So corporations can be classified in three different ways: domestic, foreign, and alien. A domestic corporation does business within the state of its incorporation. If it goes outside of its state of incorporation, it becomes a foreign corporation. To do business, like with an LLC, it has to be authorized in that other state. It's a simple process. Again, just like an LLC, you file an application, you provide a certificate from your Secretary of State in your domestic state, and you can be recognized to do business. Alien corporations are corporations formed in another country that are doing business in one of the states in the United States. Okay. We also have public and private corporations. Public corporations are, like I mentioned before, they're formed by the U.S. government, like the United States Postal Service. Private corporations are either for profit or non-profit. Private corporations, that is, are either wholly or in part for private benefit. And then, of course, you have non-profit corporations as well. And those non-profit corporations are those that are not supposed to be making a profit. Okay? In a non-profit corporation, you don't have shareholders. You may have people that represent the corporation in terms of board members or members, but they don't get dividends. There is a sort of argument that sometimes the difference between a non-profit and a profit is covered up, blinded, whatever word you want to use. Situations where you have, for example, one of my pet peeves is so-called non-profit hospitals. They don't have any shareholders, but it's interesting because sometimes their CEO, the chief executive officer, is making like $15 million a year. So who's actually benefiting from the income of the nonprofit hospital? The board members and the CEO would probably say, oh, the patients and the public. But many people would argue that it's the people who are running the hospital who control things and to some extent set their own salaries at these exorbitant amounts. But anyway, that's one of my pet peeves. You can argue with that if you want. Okay, so that ends part 1 of chapter 18.